The top business stories live from the Sky News City studio. The UK's biggest listed commercial property company, Landsec, says valuations are starting to stabilise following the sharp rise in interest rates. I'll hear from the chief executive. The Body Shop's administrators to launch an auction of the chain after concluding an alternative restructuring isn't viable. Plus, Sainsburys and Microsoft team up to enhance the supermarket's use of artificial intelligence. Good afternoon, this is Business Live with me, Ian King. We've got a packed programme ahead of you. Before all that, a reminder of the news that's broken in the last few minutes. Israel's chief military spokesperson says Israeli forces have recovered the bodies of 3 hostages from Gaza. We will have more on that at the top of the hour with the News Hour with Jonathan Samuels. Now, the UK's biggest listed commercial property company, Land Securities, said today there were increasing signs that valuations were starting to stabilise following the sharp rise in interest rates since the end of 2021. Landsec, whose assets include Trinity shopping centre in Leeds and Bluewater in Kent, and which is a major owner of central London office buildings, was reporting earnings of £371 million for the year to the end of March, which was down 6% on the previous 12 months. I've been speaking with Landsec's chief executive, Mark Allen.
I think there's probably two parts to the story of what's been going on with central London values. I mean, first of all, over the last few years, what we have seen is continued strong demand from occupiers for the best assets. And that's driven increases in occupancy, it's driven increases in rents as well. So the underlying cash flows from those assets have been very strong. What we've had at the same time, of course, is a rise in interest rates, and that leads to a rise in valuation yields, which all else equal pushes values down a little bit. However, with the stability of rates that we are now seeing and rents still growing because that occupier demand is still strong, what we saw in the second half of our year, last year anyway, was in the West End, values stabilised. In the city, I think they're not too far behind, and in the last quarter of our year, yields across pretty much all of the sector were stable. So yields stable, rents growing. Our view at this point is that the outlook it pretty quickly turns positive.
Yeah, you make the point in the statement that you're seeing interest from investors who haven't been active in this market for a long time. What sort of people are we talking about here?
If you look at the London office market, I mean, that is probably over time the most liquid and competitive property investment market kind of anywhere in the world. So you're always going to see different types of investors in and out. I think what's happened over the last couple of years is people, I think, have been interested in what's going on within the UK, interested in the prospects for best-in-class properties, but they've been a little bit wary about what's the cost of capital, where are interest rates going. So we've known for a while there have been quite a few investors from all sorts of different backgrounds that have been on the sidelines to some extent, waiting to step in. I think our view now is that we will start to see that activity pick up slowly over the second half of 2024 and into 2025.
Now, your loan-to-value ratio rose from 31.7% to 35% during the period. You're obviously feeling a lot more confident about taking on borrowing and expanding again.
We have 2 key principles to how we run our business. The first is we try and focus our capital and our people where we think we've got long-term competitive advantage. The second is we maintain a strong balance sheet. So actually, since our March year end, we actually sold a portfolio of hotels. That's brought our LTV down to 32%. And we like to keep that, our target is to keep that in the range of 25 to 40. So given that we think the outlook for values from here is much more stable and turning positive, we would be comfortable to take our borrowing up a little bit to invest in the right quality of assets at what we think is an attractive point in the cycle. And we have about £1 billion worth of investment capacity as things stand today.
Now, another key part of your strategy is mixed-use urban neighbourhoods, and you had a bit of news on that today. I just wonder whether you think you've got the skill sets in the business for residential, given that it's not traditionally one of Landsec's strengths.
What we've shown with our results today is that through the portfolio recycling that we have been doing over the last few years, we've been concentrating our investment into a smaller number of really key, large places that have a real scarcity value. So now over 80% of our portfolio is invested in 12 of our largest core locations, and a couple of those have real residential potential. Now, you're right, it is something that Landsec hasn't necessarily been known for, although we have delivered residential in Victoria to reasonable volumes in recent years. But we've brought skills into the business. A lot of the planning capability, delivery capability is very similar to commercial real estate. What we're building is not houses, they're apartments, etc. So a lot of the supply chain can be quite similar, and we've augmented that skill base as well.
I mean, what I get from talking to you today and from reading your results statement, Mark, is that you seem quite confident about the rest of this calendar year, at least. I just wonder how much of a tailwind you think falling interest rates might be.
The most important rates, I think, for most participants in the real estate sector is where our long-term rates, and if you look at 5-year or 10-year gilts, they've been reasonably stable around the 4% level for a good few months now, and I think that is giving investors, giving us a degree of confidence of where that longer-term cost of capital is likely to settle. I think you've then got the sentiment impact of what happens to policy rates, and so whilst I think actually whether there's one or two cuts in base rate this year and exactly when that timing is, I don't think that affects the fundamentals particularly of our sector, but it does certainly have a bearing on sentiment. So that will certainly help. We're not expecting to see a sudden rapid explosion in transactional activity, but we are expecting to see a steady recovery across the rest of this year and barring any macro shocks into 25 and beyond.
Well, that was Mark Allen from Landsec speaking to me earlier. And staying with property, one of the hottest spots in the sector in the last decade has been so-called big box distribution centres, supporting activities such as e-commerce. Well, today saw two players in the sector come together as TRX Bigbox REIT completed its £924 million acquisition of smaller rival UK commercial property REIT. The enlarged business will be the UK's fourth biggest commercial property company with £6.3 billion worth of UK logistics assets. I've been speaking with Colin Godfrey. He's Chief Executive of TRX Bigbox.
TRX Bigbox is the largest investor in UK logistics, and we control the UK's largest development platform. So post this merger, we will have a portfolio of around 6.3 billion and a market cap will be around 4.2 billion. And I think it's fair to say that following the recent interest rate rises, which gave rise to valuation reductions, some companies found themselves in a tricky situation where they've been subscale and actually been trading at a discount to NAV for quite some time. From our point of view, scale is important, but fundamentally, the target company here, UKCM, is a really high quality portfolio of around about £1.2 billion, about 750 million in logistics and around 450 million in what we're calling non-strategic assets. And fundamentally, the quality of that portfolio, and particularly the logistics assets, are highly complementary to our existing big box portfolio because they provide us with really high quality urban logistics assets and enhance our customer offering and provide us with the opportunity to accelerate rental growth.
Is it more appealing to you to expand via acquisition than via organic means?
Well, we look at all options, and it's a point in time in the market, as I say, whereby the target company was trading at a discount. We're using the strength of our paper, our shares, to undertake the purchase. So this is a share-for-share transaction. But of course, we're active in the direct market as well. But this transaction in itself, in addition to the scale, it does provide us with other benefits such as enhanced financial flexibility, cost of capital benefits, increased share liquidity, and cost savings that come from the merging of two companies. There's £4 million of cost savings in there, and that will help to drive further earnings growth and dividend progression. But also, UKCM has a very low level of gearing. Our own gearing is very modest, but when you combine those two, that's another very attractive feature which further enhances our balance sheet strength.
Now, you've issued a trading statement today as well in which you note that activity is picking up. What is that going to mean in terms of rental growth for you?
We've been through a period where there was an increase in supply and occupational demand dropped really into the face of uncertainty caused by inflation. Obviously, inflation is proving a little bit stubborn, but it is on the way down. We've seen recent commentary from the Fed and from the Bank of England. Interest rate cuts are expected. I think that once those start to be implemented, we will see more occupier activity. We're already seeing that. And what I would say right now is that the market's pretty well in parity. So as we look forward, we feel that the market's in great shape and has the potential to deliver something in the order of sort of mid-single-digit rental growth, which when you add that to our running yield and asset management, et cetera, as a business, we're targeting double-digit total returns.
Do you worry that the penetration of the overall retail market by e-commerce appears to be slowing? Is that a headwind for you potentially?
One has to think about the context of, the deglobalization, shortening supply chains, the effect of Brexit on the UK economy, and that's creating reshoring, nearshoring effect. And so we are getting quite a broad range of occupier types that are now demanding space in the UK. I think that trend will continue. The component part of that was and still is e-commerce is still pretty strong, but it's against the backdrop of broader range of occupier types, including, for instance, manufacturing, which has increased quite significantly, as has third-party logistics operators. And I do see e-com continuing to grow at a faster rate than total retail sales as the high street continues to shrink.
Some other business news stories for you now. And the Body Shop's administrators will launch an auction of the chain after concluding an alternative restructuring isn't viable. Sky News' city editor Mark Kleiman has learned that FRP Advisory, which has been overseeing the collapsed business since January, will begin formally sounding out potential buyers in coming weeks. The chain currently trades from around 100 stores following a programme of shop closures and redundancies in recent months. Sainsbury's has struck a 5-year strategic partnership with Microsoft aimed at enhancing the supermarket's use of artificial intelligence. Under the agreement, Microsoft's AI and machine learning capabilities will be applied to Sainsbury's customer data with the aim of making shopping more convenient for millions of customers, both online and in store. Sainsbury's said that by using generative AI, it could create a more interactive online shopping experience, while in store, it would be able to make processes like shelf replenishment more efficient. Now, this week has seen senior representatives from the world's biggest tech firms, the likes of Meta, Google, Microsoft, Netflix and TikTok, descend on London for Advertising Week Europe, the continent's largest gathering of the creative industries. Well, in theory, this should be a good year for the industry with the US presidential election and the Olympics, but there are a multitude of challenges, not least adapting to a wave of technological change. Well, earlier, I spoke with Ruth Mortimer, Global President at Advertising Week Europe.
I think there's both great excitement about AI and also some trepidation. It's really changing the creative process. It's allowing creatives to have a feedback loop. You can put out a campaign, get the feedback from the public and then feed it back in using AI as the process and generate creative that better fits what they want and performs better. That's really exciting. And at the same time, people are really anxious. One of the things we saw was we did some research with Cint all about misinformation, deepfakes and AI. And one of the things we saw was great anxiety about how much in the upcoming election AI would be used to misinform the public.
Now, you've had all the big guns of the tech sector with you, the likes of Meta, Google, TikTok. I mean, Sir Martin Sorrell used to refer to these sort of businesses as frenemies. What's the relationship like these days?
I think a lot of them are still frenemies of each other, but I think actually one of the great things about Advertising Week is everyone can come along. So we have Netflix there alongside Google, alongside Meta, alongside TikTok. And we believe it's actually when you meet other people in that world, more comes of it rather than less. So we encourage frenemies, bring them on.
Now, traditionally, election years, US presidential election years, are very, very good for the ad industry. We've obviously got an election here in this country as well. What sort of boost to activity is that going to generate?
I think it is going to generate some. And one of the things our research showed was that actually political advertising is the thing the public said would most sway their vote. So you know how I often feel people say, oh, advertising doesn't work on me. Well, the research shows that people really do believe that political advertising across all age groups works on them. It was the biggest single factor to sway their vote.
But you also found that a lot of people don't realise what goes on behind the scenes in terms of regulation of political advertising.
Yeah, this was a very interesting insight. So we found that just 15% of boomers, that's people aged 60 and above, thought that political advertising was regulated, which it isn't. Whereas a much larger proportion of younger people, nearly kind of 60% of Generation Zs, 27 and below, they actually think that political advertising is regulated. And I don't know how many people out there, Ian, know this, but where most things, you know, my shoes, my clothes, the butter I eat, that's regulated by the Advertising Standards Authority, so you cannot make untrue statement. That is not so for political advertising.
Which is absolutely astonishing. Why is that?
I think it's because it's traditionally been so live and real time. It's actually quite difficult to work out a mechanic to be able to quick enough track it, respond to it and rule on it. That's not a very easy process. There's actually a reform group from within the advertising world that would really love to change that. And I think, you know what, with technology, why are we not looking at this issue again? This is probably the advertising that most affects our everyday life, so we should do something about it.
More breaking news, detail on the breaking news that we brought you earlier this hour. The Israeli military says it's recovered the bodies of 3 Israeli hostages in Gaza. They include German-Israeli Shani Luke, whose body was seen in the back of a pickup truck on the 7th of October last year. That, of course, a picture that became one of the defining images of the Hamas attack on Israel on that day. We'll have more on that throughout the evening here on Sky News. Still to come on Business Live, we'll have a look at how the markets have done this Friday afternoon. Don't go away.
We've got your Sunday mornings covered. From the front page and the sounds of the streets to the voices of the people who make the major calls and big picture politics beyond Westminster. We'll put you at the heart of our story. A new start to Sunday.
I'm ready. Are you?
Join me, Trevor Phillips, Sunday mornings on Sky News.
Dominic Waghorn, Sky's International Affairs Editor. We're seeing the world get more and more divided, and it's our job to try to make sense of it all.
Well, European stocks are going into the weekend on a downbeat note. Here's how the main continental European indices have finished. Only the IBEX in Madrid finishing in positive territory. Talking points this afternoon include the Swiss luxury goods giant Richemont. It's risen by nearly 6% in Zurich on news of a management chief reshuffle and better than expected trading update. Well, here in London, the FTSE 100 has finished off just over 1/5%. The mining heavyweight Rio Tinto has led blue chip gainers this afternoon. That's on the back of a bit of positive broker comment, up nearly 2.5%. While Sage, which you'll recall, we had the CEO of the company on the programme this time yesterday, that's rallied 2%. It sold off pretty heavily yesterday. Meanwhile, HSBC, you can see at the bottom of the screen, quite surprising to see that one in positive territory. That's on reports, despite reports even, that Chinese insurance giant Ping An, which is its biggest shareholder, is looking to offload some of its 8% stake. To the downside, Haleon is off by just over 1%. That's on news that its former parent GSK announced it was selling the remainder of its shareholding in the consumer healthcare group. Meanwhile, outside the FTSE 100, Auction Technology Group is up another 3.5% after yesterday's results, which on the day sent it up more than 12%. Over on Wall Street, equities are building on their gains from last night. The S&P 500 and the Nasdaq are on course for a fourth consecutive week of gains, while the Dow Jones is in line for its fifth. Talking points this afternoon include Reddit. That's up 13% on news that it's going to be bringing its content to ChatGPT. Well, the foreign exchange markets, the dollar's been on the back foot this afternoon. Sterling up 0.25% against the greenback. The euro's up 1/5% against the dollar as well. Sterling's up 1/5% against the dollar. Meanwhile, the single currency slightly ahead against the dollar there. As for the oil price, well, that is on target for its first weekly gain in 3. Barrel of Brent crude will currently set you back $83.63 a barrel. That's up a little under 0.5% on the session. Joining me now is Tineke Fricke, Head of UK Equity Research at Waverton Investment Management. Tineke, great to see you. What did you make of the property companies? We've had two of the big ones on the programme today. What did you make of what they're saying?
Well, we obviously heard most from Land Securities because it was their full year results. And by and large, their results were probably in line. So what we're really looking at, well, how are they seeing the future? And I think the earnings forecast for the next year and the year after were probably a bit below what people thought. So therefore, the shares were down a little bit. And obviously, Tritex was a quarterly update, and they're feeling, a little bit more positive about life.
Yeah, I mean, they obviously still think there's plenty of growth to go for in this sector.
Yeah. They benefit from, having bought UK commercial REITs, so they can keep the best assets and dispose some of the others. But yes, there's clearly still demand for warehousing, and we're starting to, because last year we had lots of people pondering over it, but now they're actually signing leases.
Yeah, and potentially this gets TRX Bigbox into the FTSE 100 as well, we should mention.
Yes, I think it depends a bit. It's always a bit difficult because there's still a lot of properties to be sold and there's lots of moving parts. But yes, it's clearly a bigger business going forward.
Yeah, definitely one to watch, I think. Richemont over on continental Europe, probably the highlight of the day there.
Yes, no, for those who don't know, it's Cartier's their main brand, and people have been nervous about luxury companies, and the shares kind of from March have just been on a downward trend, particularly on fears around China, but the numbers were better than expected, so there was a bounce back. We all look at, how is it moving quarter by quarter, and particularly their last quarter was strong everywhere other than Asia Pacific, probably China, with Japan knocking it out at 40%, really strong.
What I find really interesting about this, though, is that we obviously had a pretty downbeat trading update from Burberry the other day, and one or two of the others, Kering, for example, their numbers haven't been brilliant recently. So it feels like Richemont's actually doing better than the pack.
There are differences. Burberry is very, very reliant on China. So if you're reliant on an area that slows a lot, but there might be some other issues because they were slowing in the US as well. So it is a bit product specific and where you're focused. And clearly Richemont exceeded expectations, and the CEO who was announced was the best man for the job. So people are very happy with that.
Well, you mentioned China, obviously HSBC, big FTSE company. Very interesting situation there with Ping An.
Yeah, so Ping An has an 8.8% stake in HSBC, and for some time has been trying hard to break up the company and be left with a Hong Kong-based bank and the rest. And basically they haven't succeeded because there is merit to the combined group, and I think the board has argued they would lose value. So I think Ping An has decided, right, enough is enough, we're going to place our stakes, and 8.8% is not that much, whilst it's something. It's really when stakes get into sort of 30% plus, then it becomes a real issue for the shares. But clearly the Chinese better sort of industrial production number helped as well for HSBC.
Yeah, maybe it does show there are limits to activist investment after all. Tineke, got to leave it there. Great to see you. Thank you. That's it from me. I'm back again on Monday morning with the next edition of Business Live. That, of course, is at 11:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up next, it's Jonathan Samuels with the News Hour. Thanks for joining me today. Have a great weekend. Cheerio.